Good afternoon, everybody, and welcome to another LendIt Fintech weekly news show. My name is Peter Renton, chairman and co-founder of LendIt Fintech. And joining me, as always, Todd Anderson. How are you doing, Todd?
I'm good, Peter. How are you?
I'm doing great. And also today, in the room next door to Todd, in our New York office, is Kevin Travers. How are you doing, Kevin?
Great. Happy to be back.
Right, back for the second time. And of course, I am, as always, in my studio here in Denver, Colorado. So let's get right into it. First story I want to talk about today is Coinbase. Coinbase finally released their NFT platform in limited release, shall we say. They announced it 6 months ago. We knew it was coming. They've released a lot more details of it, and it looks pretty good. I mean, basically, it only works with Ethereum-based NFTs right now, which is the most NFTs. You have at least all, like OpenSea, I think, is a similar sort of system, but you can use your Coinbase wallet. You can use other self-custody wallets. It's a pretty interesting thing. What do you guys think?
I mean, it's a natural evolution of Coinbase's, ecosystem. They're just going to keep building and building and building. They're arguably the behemoth in the space. Obviously, FTX is, probably, up there in terms of on their way to being on par with Coinbase. They're not there yet, but I think the interesting part to me long term is you're going to have a bunch of NFT, marketplaces and platforms. Eventually, there'll be this compression of fees, like we've seen in trading, like we've seen in other markets, and kind of what will end up happening. I don't think we know right now. There's lots of different fees in crypto, depending on what blockchain you're using and what asset you're trying to trade. But over the long term, there'll be this compression of fees, and what that might mean to a lot of these business models, because there is a lot of money being made on fees right now. And you would think, just like in the trading world, that those are going to start to creep downwards when we get to, say, 3-5 years from now, when things are kind of in a more regulated, stable place.
So, Kevin, are you going to move your NFTs over to Coinbase?
I sure hope so. I signed up for the launch, the whitelist. I'm in position of 220,000.
That's actually pretty good.
In front of the line. I signed up the day that it launched, and I'm still there. So I'm looking forward to the full launch. I know it's open to just a handful of creators to sort of test it out. I'm hoping, I don't know, looking at what OpenSea did and creating like a decentralized online, like eBay basically, but it doesn't have servers and it doesn't have to pay credit card fees or anything like that. It's going to be cool to see who is the next to capture that sort of windfall of cash they got. But ever since Coinbase went public, it's like they've been slow to react, because even today it's still not a launched NFT platform. So either it's harder than we think to catch that lightning, or maybe that's just what it's like to be a public company and having to move slow after sort of being the forefront, as Todd said, of the crypto industry for so long.
Yeah, I'm sure they saw what OpenSea did and they thought, oh my goodness, we should have done that. But they didn't, did they?
Well, not yet, at least.
Yeah. Anyway, let's move on to Robinhood. Robinhood is making an acquisition. Ziglu is the name of this company. This is in the UK. So Robinhood is expanding to the UK. They tried to expand to the UK a couple of years ago and then abandoned their plans. Looks like they're back. They've acquired a crypto platform. So it's a pretty small platform. In the last valuation was £85 million. They've raised £17.5 million. So maybe Robinhood bought them for a couple $100 million, something like that. But it gives them a foothold into the UK market, and it seems like obviously this is not a platform that trades stocks or anything else other than the I think 11 cryptocurrencies they have right now. So pretty small kind of play, but Robinhood's just, I guess, deciding that they need to get serious about international expansion.
I think reading the story, the thing that struck me was this is one of, I think, the only or one of a few crypto regulated platforms through the FCA.
Yeah. Yeah. They were the third, I believe.
This is essentially an acquisition of an FCA regulated platform, because, Robinhood has had a lot of issues with regulators in the past.
In this country,
And
yes.
yeah, and in general, I'm sure regulators around the world have kept an eye on kind of what's going on with them, and it's no surprise that the acquisition they make, it's not a huge splashy acquisition, but it does that caveat with it. And so maybe they thought, hey, we've had issues trying to expand globally. Let's do it through an acquisition, and an acquisition that already has the FCA stamp of approval.
Yep.
And then see where we can go from there.
It's a lot like, I think, a fintech brand buying a bank that already has some sort of license in the US. We see that a bunch, and it sort of feels like that as like a small step and a cheap step, frankly. Robinhood's last funding round before they went public was like $1 billion, and their Series H or like W or something. So it's not, whatever they picked it up for isn't a huge trump of change. But again, it's like the same thing with Coinbase, where I see like a public company that splashed big in retail investing before, and then suddenly regulators and people took notice, and then they had to pull back. I don't know. It's going to be cool to see if it works. It feels like they should have jumped towards crypto sooner. It feels like they should be going NFTs like Coinbase is. Like they already offer some sort of crypto trading. They already offer a wallet recently. But it'll be cool to see, I guess, where it goes from here.
Yeah. Yeah. Well,
in Europe, the Europe and UK as a whole is the largest crypto community by volume, I believe, in the world. It's about 25% of the world's crypto trading volume, if I'm correct there with my numbers. And so I think Robinhood probably sees two things. One, a regulated FCA platform, which gives them an in to the UK and maybe to Europe next, and better access to the European community as a whole. And while Europe and the UK are separate, it's very much, the umbrella is, not that far off from having both underneath it.
Yep. Okay, moving on. Our next story, I love this story. It's so SBF, the CEO of FTX, Sam Bankman-Fried, he met with David Solomon, who's the CEO of Goldman Sachs, in the Caribbean, right, just this week. And I'm sure they both flew on their private jet and had cocktails on the beach or something. But that's how it works in my mind, anyway.
And maybe D-Sol, his DJ alter ego, put on a show as well.
Maybe he brought his deck and was doing a little show. So Goldman, it's interesting. Obviously, Goldman, they want to do the IPO. I mean, FTX is worth $32 billion in their last funding round. This is a big company valuation-wise, even though they only began 3 years ago. They're still really a decent size. And Goldman want that business for the IPO, so there's that piece. Goldman also want to provide banking services, they said, and providing advice for maneuvering, not around, but how to talk with US regulators, which I'm sure David Solomon knows far, far more than SBF has any clue about. But it's just fascinating. You got this new guy, like he's 30 years old. He's a multi-billionaire. He moved from Hong Kong to the Bahamas, his business, and now he's got David Solomon flying in on a private jet to meet with him. So
I'd love to be a fly on the wall. Like, we can help you raise money. Yeah, I don't need there.
Yeah.
We can help you go public. I'm okay. We can help you with regulators. Well, maybe I'll take you up on that one.
Yeah, if they should, because that's one thing that
they've
really
had zero problems raising money.
Yeah.
He's built a business in no short, arguably the fastest that we've seen go to 32 billion. That's at least that I can remember off the top of my head. And then, of course, you have Goldman kind of swoop in and go, hey, we're here for you, type pitch, which I think is funny. It'd be curious to see they end up doing something. I mean, the regulator aspect is really the one I see on the face of it that seems most interesting, because FTX has the FTX brand, then they have FTX FTX.us, which is significantly smaller than the broader FTX brand. So maybe there's some level of partnership there to build up the .us one. I don't know, but either way, it's just a fascinating article.
Mm-hmm.
It's cool. It would be cool to be there and see what that conversation could even be like. Like the nutty professor tech. I mean, he's 30, but he seems like the Mark Zuckerberg of crypto, even though Zuckerberg was much younger when he was building Facebook. But this is a guy that has Tom Brady in his commercials, and he has an FTX arena where I think what the Miami Heat play there. He's like this giant mogul, but he doesn't have the traditional like banking know-how that a brand like, I mean, a giant like Goldman Sachs does. And so I mean, I can't imagine what else they would be asking for, but like the blessing of this like banking giant, right? Like this is how you get past. This is how you make it cool with the SEC. This is how you get banking licenses. Because who knows if they're even going public anytime soon after the performance of.
They certainly don't need to now. The money is just flowing. But I'm hopeful that David Solomon also asked SBF a lot of questions. And I imagine he probably did. He's a smart guy. He knows what he doesn't know, but SBF knows far more than David Solomon will ever know, I think, about crypto. And so that's something that, as I said, I mean, it's.
But I do think it does. And the article, I think the CoinDesk article that I read about this mentions it. It's just another stamp of approval that traditional FIs are looking, and even conservative ones, are looking at crypto and saying, how do we get involved? How do we learn? How do we become part of the movement, but yet in a regulated way?
Yep. Okay. Next story is this I didn't know about this. This was new information. Apparently they've been around for a little while in stealth mode. But William Hockey, who was one of the co-founders of Plaid, he left in 2019. I'm sure he still has a big chunk of stock. They say he's a billionaire. And last time Plaid was valued at 13 plus billion. So he could have 10% of the company still. And he's hopefully hasn't sold a whole lot. But anyway, he's created a company. He's calling it a financial infrastructure bank. It's called Column. Which I'd never heard of, and they just came out of stealth. I think it was today or yesterday. It was this week anyway. And they're providing. It looks like a Cross River Bank type model, like a newer kind of like a faster, more agile. I shouldn't say that because I think Cross River Bank are actually they do a pretty good job, but they are basically saying fintechs can partner with us and launch pretty much any product they want, and it's all like developer friendly, very much focused on that. And it's another. I mean, it's an interesting company. Banking as a service is hot, and they are really they have a banking license. They acquired a California community bank last year for $50 million, so they have a banking license, and that's what surprised me. I thought, how can a new bank launch? Yeah, I've heard of this company. Yes, they've got a banking license.
The article, to be honest, felt a little misleading when you read it, because it was giving the impression that they built this thing from scratch, when in reality they did exactly what Lending Club and SoFi did.
Right,
they purchased a bank, and now they've created a new financial infrastructure to that bank, or maybe they created it by itself and just used the bank charter to become compliant. But reading it to begin with is like, wow, they did all this new, like, how long have they been in stealth mode, thinking back to like what Current did by building their own their own core. But I think this trend is going to be one that we're going to see more of, which is fintechs need to figure out ways to diversify their revenue. SoFi did it through 2 acquisitions, the bank and actually 3, the bank, Galileo, now Technisys. Lending Club did it through Radius Bank. Column has done it through this community bank, and now they're going to become clearly a force to at least be reckoned with in some way. And you have Cross River who's on the bleeding edge as well, and you'll probably see others. So I think it's part of a wider trend. A little misleading in the way they presented the article, though.
Mm-hmm. I totally agree. When you read that they come out of stealth mode. They have 60 employees. They built this whole thing, but then you figure out that he just sort of went down to the candy store and bought, a community bank for 50 million. People have done that before. And in the case of other major fintech or neobanks like Lending Club, SoFi, they had a huge, $1 billion organizations before they even bought their bank, just for the regulatory licenses and just to expand their products. It feels like it's like a fintech bank by way of SPAC or something, except regulatory wise. They bought this title, so now they are claiming that they are this out of a stealth bank, but it feels like they don't have partners yet at all. It sort of came out of nowhere.
They if you look at the TechCrunch article, they did have obviously Plaid's connected to every single bank and fintech in the country.
The part I think is probably most interesting is, are they looking to remove the abstraction layers, the Syncteras of the world, those types of companies, because those act as basically an intermediary between community bank and X partner.
Yeah.
And if you just work with Column, do you need an abstraction layer? Which
no, I think that's the whole
sound
point.
like that's the so there's their value prop is, why go this route, which just complicates your stack if you can come to us and we can make it simplified.
Yeah, they're saying you don't need a Synctera, you don't need a modern treasury, you don't need a seal of money. And I'm just looking at the TechCrunch article, and they do say they actually have customers right now. They're working with Brex. They obviously have Plaid as a customer, Brex, Oxygen, and Nearside, which I've never heard of. But
that's a new one.
So they are working. They've been what I think they've done is they've got you need a banking license for all these fintechs need to work with a bank that of some sort to get the banking license so they can lend money or take deposits or what have you. And so they need that. And rather than but what they've done, it looks to me like they're creating like this whole developer friendly atmosphere. It's like Stripe kind of did when they first launched. Like here's our SDK, go and create whatever you want, and we'll help we'll help sort of process it. That's kind of what it feels like to me. And I think it's probably what Gilles would have done at Cross River if he was starting it now instead of back in 2008.
Yeah, probably. I mean, he helped build and start Plaid, so he's clearly got a reputation for, even the TechCrunch misspells his name.
Yes, they did. They did that. Yes. Okay, moving on. We've seen a lot of crypto credit cards launched this year, and this to me has been the most interesting one. Nexo, which is really they're a I don't know exactly how to describe them. They're a crypto. They have a crypto token called Nexo, and it's Nexo.io. So they're sort of are they a marketplace for crypto? I presume that's what they are, but I should really know exactly what they are. But anyway, they've got a credit card now. This is launched in Europe, where because if you have your crypto with Nexo, like in on their custodied at Nexo, then you can spend, you basically can get a credit limit. So say you put, say $10,000 worth of crypto with Nexo, you can then get a credit line up to 90% of the value. So you just deposit that with Nexo. You get a crypto. It's sort of like almost like a secured credit card in some ways, 90% of the value of the crypto. But what's really cool is that if you actually over collateralize, like with I think it was 5x times the collateral, then you pay 0% interest with no minimum monthly payments, which I thought was interesting. So it's it's basically a credit card, secured credit card backed by crypto, but you get to spend. It's not spending crypto as you go like some of the other credit cards are. It's just a regular credit card that you pay off with crypto.
They, bill themselves as the world's largest and most trusted lending institution in the digital finance industry. So they're primarily lenders. They according to their website, manage assets for 4 million users across 200 jurisdictions.
Wow, that's every country in the world.
Yeah,
Yeah, pretty much. I mean, the most interesting part is the you don't have like a lot of crypto related credit cards sell your crypto.
Right.
This one doesn't, and so it's just hold or hodl, as they might say, while you spend. And so, this gives those in the crypto space the ability to basically take a credit line against their crypto and not have to sell it. And so it's a innovative product. I think you'll see more stuff like this. And those that are crypto enthusiasts don't want to get rid of their crypto, and so this is the option that allows them to keep their assets. So it's plays right into the enthusiast, and I believe we've had Nexo, the CEO Anthony, speak at our European event back in 2018, I believe.
Got a good memory.
Yeah, Antonin Trenchev, I believe his name is.
So they've been lending, I guess, like this for a while, but this is the first time it's collateralized in or underwritten in this type of way. And that is what I was going to say. It is so cool that you don't need to sell your crypto. You can just use it as collateral to spend in whatever your, I guess, regional currency would be. Like, I guess you're spending it in US dollars. That's cool. Especially if you have like $200,000 or whatever in Bitcoin and Ethereum. Imagine being able to use 90% of that or 5 times that in, I mean, that's pretty cool for people that are crypto enthusiasts and want to hold on to it. I wouldn't be personally, like on terms of like a credit product, I wouldn't be personally comfortable with spending 90% of my credit allowance and then only spending like a small minimum on it. I'm not comfortable unless the whole minimum is gone.
Right.
So it's sort of like a much different product than I would be used to. But maybe people who are crypto 100% or crypto maxis would really appreciate something like that.
Yep. I think that's who they're going after for sure. Okay, moving on. This was an article, front page of the Wall Street Journal this week. It really caught my eye. Cutting edge crypto coins tout stability. Critics call them dangerous. This is all about stable coins, and particularly algorithmic stable coins. And this is complex. And I love Matt Levine had a one of his columns this week on Bloomberg. He wrote, I love his writing style. And he basically said, because he looked at the Luna coin is going nuts. And the Terra stable coin, which is interplayed with that. So you basically, if you read Matt Levine's piece, he has a great thing about how it's just it's inherently not stable. And that's, and I listened to a Bankless podcast over the weekend with the guy from Frax. I still didn't understand it very much, but basically it's algorithmic stablecoins uses algorithms to keep the balance to $1 US. And so and it's basically all about, 2 coins, like there's Terra and Luna, and they're both being kind of sold or bought to keep the balance at $1. And, it's the people that tout it think that it's a far better system, because it's done with smart contracts rather than just with backing it with other types of currencies. But I don't know. I feel like for me, I like if you're going to have something that's asset backed, I'd like it to be backed with something that's inherently worth like treasuries or something that has real value.
This sounds also a lot like what SBF was talking about with did that event with A-Rod. Was talking about I forget exactly what it was. It wasn't trading. It was I forget.
I think it was
basically the
CFTC thing. It was a CFTC thing.
The algorithmic way is safer because as long as the rules are set correctly, it will always sell when something reaches a certain trigger point. And so that is the theory with it. The other, I guess, worry is in this or any other algorithm thing is hacks. And what'll happen if someone hacks into the algorithm, or if the algorithm is poorly constructed, or someone screws up something, then how much systemic risk enters the system unbeknownst to someone or quickly, and does the stopgap of a human involved help some of this? I mean, I agree with your premise, Peter, with the treasuries and whatnot, but I think we're still a little ways away from everyone getting comfortable with this. I think we're on the path to it eventually, with probably some safeguards in place with humans, but I think we still got a little bit of, as Bo would say, wood to chop here.
I think it is still, Bo would also say, and I believe it's still fascinating to watch this attempt to code this perfect store of value. I think, even as you were saying, algorithms can fail though. There's been flash crashes in like trading algorithms in commodities and stuff that have sent prices dropping by millions, even in like the normal stock market, not even this new crypto thing.
Right.
I mean, the article also talked about a stable coin that it was like this paired to another one that's supposed to find like 1-to-1 value that crashed earlier last year. Janet Yellen talked about it in her speech, and it went from like $1 to 75 cents, and it lost investors $2 billion in like a couple minutes. But it's still, I mean, obviously the worst nightmare. It's a bank run, but it's not even anyone's fault that it's running away. Right.
Yeah. Anyway, moving on. I want to tee up one of your articles from this week, Kevin. I thought this was really interesting about, everyone talks about customer acquisition and growth of customers, but what happens after they've been onboarded. So why don't you tee it up for us, Kevin?
Yeah. So I met Adam Wesley from the SVP at Digital Onboarding Inc. They basically, when we met, the most interesting thing he had said to me that sort of inspired me to write this whole article is he said they work with brands that spend millions of dollars to get customers in the door and get digital apps. During the pandemic, everyone did this, especially financial institutions. Mm-hmm. And then after spending these millions and millions, getting through the sales funnel, getting people to create a new account, put in their, open a credit card, open a debit card, within a year, 25 to 50% of those new customers are gone. They either go inactive or they just walk out the door because so much infrastructure is built around getting the sale, but not keeping the customer there. And he says the easiest way, as part of his business pitch, really, the easiest way to lower costs is by internally supporting your own customers you already have more. Mm-hmm. If you can cut 30% loss into 15%, that's like a double. I don't know. It was very interesting and cool talk to realize. When he said that stat, I was like, I have to write about this. That's fascinating because we work with people that probably deal with this problem every day.
Yep.
It's all about customer acquisition versus, I think what's the Facebook term, like monthly active users. Like, you want to take them, then cross-sell them a new product from you, re-underwrite them in a year and say, hey, your mortgage is due for a refinance. Market rates are this. You're pre-approved for this. Like, there's some of that going on, but probably not nearly enough. And I think, highlighting it just underscores the fact that there's still a long way to go in a lot of financial products.
Yep. Very good point.
Data is only getting more voluminous and more intricate. And so I think that this trend will hopefully start to shift.
Yep. Okay. We're going to close with the last article from Ron Shevlin, our good friend who's been on the news show several times. He took issue with some comments that Senator Sherrod Brown had, and some of these it was not a very smart things to say. Like, talk about neobanks are dangerous. Users could lose their money. He of all people should know that they have a partner bank they work with against that have the hidden fees. So I appreciated Ron's basically taking him on, saying you were wrong.
Some of this is not even that difficult to break down. Look at any neobank, go in the fine print. They'll tell you exactly who they're working with.
Yep.
These companies aren't trying to hide the fact they work with Celtic Bank or Cross River Bank or Web Bank or whoever bank, Sunrise Banks. And if something's FDIC insured, it's FDIC insured. And it goes to the point we've talked about many times, is that a lot of legislatures look at things through a very simple lens, and they don't try to get the depth, and they need to, because this is simple stuff compared to the crypto web.
Yep.
And they are a long ways away from trying to fully grasp that.
And it's going to take a while to get there, I guess. I think he's referring to a ProPublica article that looked at people depositing their stimulus checks into Chime from last year. That is still resurfacing somehow, even though it came out in June. And even then, I believed it when it came out, and then we thought about it and realized, well, I mean, compare the complaints that Chime got to the complaints that Bank of America got, and it's almost the exact same number per. Shevlin pointed out per million, it's like 103 for Chime, 105 for every, or 150 for Bank of America.
Yeah, so Bank of America gets more complaints than Chime.
Yeah.
So yeah, it's just easy to bash those guys. Anyway, we are out of time. Thank you, Kevin. Thank you, Todd. Before I go though, LendIt Fintech USA happening in New York next month. Tickets are coming in thick and fast right now. So it's going to be the biggest fintech show of the year so far. Make sure you go there, lendit.com for more details. So with that, thank you everybody for watching or for listening, and we'll be back same time next week. See you guys.
Adios. Buy your tickets.